I just say, look at the pens. I go, all right, like 3 pens are in the car.
So thank you for coming here today. We're a little bit behind schedule. Thank you for those of you that are logging in remotely. We got excited about breakfast here. So hopefully you can join us next time, but we understand that sometimes time constraints allow for something different. So if you're not familiar to Darden Wealth Group, we are a local Ann Arbor firm. We opened the doors about a year ago, and we're excited to be here. This is our mid-market update. And my name is Andrea Darden, the founder and owner of Darden Wealth Group. So, without further ado, I want to keep us on schedule, so I'm going to introduce Nikhil Majitia in a second. But also, wanted to let you know, after this is going to be recorded, so you can go on the web, keep the link that you have, and you can rewind it, play it again. Also on our website will be other blogs that we'll be posting. We won't be spamming everybody out every time we post a blog. So bookmark our page. We'll be posting both planning as well as market different blogs throughout the month. So Nikhil Majitia, please.
All right, thank you. Hey, thank you all for coming in and welcome. Again, if you haven't met me, I think all the folks here have met me, so nice to meet you again. But for folks online, I've been with Andrea since last May. Prior to this, I've worked with a trust company in Champaign, Illinois, UC Trust Company. And then prior to that, I was with a couple of small, mid-sized RIAs in Chicago and in Washington, D.C. area. I do have the credentials CFA and CFP, so again, whatever happens here, the decisions we make on the portfolio side, I'm responsible for that, alongside Andrea, obviously, but you could blame me if something is wrong with your accounts, obviously. So where things stand right now, we're going to start with, we'll cover year-to-date performance of various asset classes. We're going to go over the economic backdrop right now, and then we'll cover the equity markets a little bit, because that's what the concern is for most folks. And then we'll cover it with Q&A. Again, anytime during the interaction, if you have questions, feel free to ask a question and we'll cover it. So we'll make it as interactive as possible. So with that, where things stand right now, again, last year the U.S. economy grew by about 3.1%. This year, the first quarter also grew by about 3.1%. The second quarter GDP that ended in June, for the second quarter, the real GDP growth was about 2.1%. It was just announced this morning. If you're coming on the way here, you might have heard on the radio. So the second quarter growth has weakened a little bit. The backdrop overall outside of the U.S. is a little more weak, and that's the concern for central banks as well, obviously. Number two, U.S.-China trade issue, obviously not resolved in a cruise mode right now, but that's one of the concerns we have as well, obviously. So again, this is the length, the most lengthiest expansion now at 121 months. So we're a little bit cautious that we're in the late cycle of the economic expansion at this point. Outside of that, so what is our positioning right now? We are a little bit cautious given this backdrop of weakening global macro trends, a little bit of weakening growth, more so in China as well. Europe is weak as well. U.S. is strong, but the cross currents have gone a little bit more negative. We are positioned defensively, as most of you know, looking at your portfolios, if you do pay attention. And the reason for that is weakening global macro trends, peaking earnings, number two, and number three, the trade issue, obviously, and market technicals. Some of the leaders have not made new highs in the last 6 months or so. The FANGs, if you know the acronym, Facebook, Apple, Google, Netflix, and Amazon haven't made new highs in the last 6 months or so. Dow Transports haven't made new highs. So when we see divergences, some of the leaders not making new highs, it's a concern too. So with that backdrop, we're going to start covering the year-to-date performance and some of the other things we've listed here. Any questions so far? Okay. So I'll jump to the next slide. Year-to-date performance has been pretty strong for most asset classes. If you just look at the 6 months time frame, bonds are up about 5%. A blended portfolio of stocks and bonds is up about anywhere from 7 to 10% if you have a mix of stocks and bonds, and that's considered a blended moderate risk portfolio. It could be a 50-50 mix of stocks and bonds, a 60-40 mix. So that's up in the 7 to 10% range. If you again, gold has done well because the central bank or the Federal Reserve has changed their policy tune a little bit. They're talking about cutting rates as early as next week. They've been raising rates until December of last year. And given the cross currents we have seen since first quarter of this year, escalating trade war, slowing global growth, and weakening inflation, they've decided they're going to cut rates a little bit based on some indicators they see out there. And that's been our concern too, obviously, that weakening trends basically. Emerging market, international markets that are up in the 10 to 15% range. The Dow, S&P, and NASDAQ are up in the 15+% range for the year. Second quarter was the strongest for gold because Federal Reserve decided to change their tune and started talking about cutting rates. So anytime rates go down, cost of carry goes down for gold, and there's uncertainty, gold catches a bid. So gold has done well again. That's as of June end. It may change based on today's GDP data. Rates may start to perk up again, and expectations for rate cut may get tempered down a little bit, basically. So growth has done better than value. A longer dated bond or credit oriented bonds, corporate bonds or high yield bonds have done better than aggregate bond index. We are a little bit heavy on the cash side and shorter dated bond, and those have done between 0 and 3%. Cash or money market is up 1% and change in the first 6 months, and overall money markets are yielding 2% and change in U.S. money market. Globally, if you go outside of U.S., everything is negative yield, especially in Europe and Japan, not the emerging markets. So growth has done better than value overall, and small caps have struggled too. If you look a little bit longer time frame over last 12 to 18 months, international stocks haven't done much. They're down about 1%. Small caps are down about 3%. U.S. large caps is the only outlier a little bit because things are strong for a lot of these monopoly companies like the Googles and Apples, the FANGs, which are now sort of a contention issue for governments around the world. They want to tax them more. They want to increase regulation on them more. So that's one of the reasons they haven't made new highs. So growth has done well. Value has struggled a little bit. Small caps have struggled. Overall, U.S. large caps, if you look at 1 year time frame and beyond, they're in the 3 to 5% up range, basically. Any questions here? We'll jump to the economic overview. So you may have heard already, this is the lengthiest expansion in the history now, economic expansion for U.S. This month. It became the lengthiest expansion. This chart here, it shows you the length and the strength of U.S. economic expansion. So on the left side, you have the length of the expansion, average length. When I say expansion, there's recession and expansion, So this covers the expansion side and recessions, basically. Average recession has been 15 months since 1900. Average length of the expansion has been 48 months. And on the right side of this chart here, the first chart on the left, you see the length of the expansions since the 80s has been more longer compared to prior history. That's because interest rates have been generally coming down and inflation has been coming down. So when inflation is under control, interest rates are more accommodative, you get more lengthier expansions. On the right side, you see the strength of the expansion. How strong was the expansion for workers, for GDP growth, overall economy adjusting for inflation? How much did it grow, basically? So this, the bottom one, obviously, it's at 121 months now, but it's, sorry, it's 121 months here, but this is, it's only grown up by about 25%, adjusting for inflation. This is the, from the prior peak. So in 2007, if you start, it went down by about 4 or 5% during the contraction, and since then it's come up, adjusting for inflation, GDP is up about 20%. That's a weak expansion. It's the longest one, but it's the weakest one compared to other expansions. If you see the red one, that was the 90s expansion, the IT boom, if you will, Windows and Intel boom, that PCs were adopted across the board in populations and corporations, basically. And this one here is the 60s one, when baby boomers were just coming off age and they're you know, forming houses and creating babies in houses, obviously. And that was the most strongest one, obviously. And then you have the 80s one, another strong expansion. That was because of interest rates coming down from 14% all the way to practically 1% and change today, basically. But 80s, you had strong tailwinds from Reaganomics, some tax changes, obviously, but mostly outside of presidents, it's the interest rates and inflation background that was helping. So any questions here on the expansions?
How do they usually end?
How do they usually end? So expansions don't die of old age because we tend to be, I guess, focused more. But yeah, they don't die of old age. There has to be a catalyst. For example, take the 2001 expansion. That was because the Federal Reserve had to raise rates so much because people were flipping houses. There was a bubble in there. The 2000 bubble was isolated in a certain sector, but extreme valuation. So when you get a negative growth starting to show up in a sector which is the booming sector, like housing or tech boom, you start to see impact overall, you know, basically. So either Fed takes aggressive stance because inflation is sparking up, or they're trying to break the bubble, or there is a geopolitical event. Could be a war, or in this context right now, what could end this expansion? Fed was aggressive, and that's why we had that sell-off in the fourth quarter, because inflation was sparking up a little bit, and Fed said, hey, we're doing our job here. We had the fiscal stimulus last year, so we need to tamper down a little bit. Employment is full, employment is at 2%. So they were going neutral, not as restrictive, basically. So what could end this one? It's the trade tariff war, or a geopolitical war, or if you don't have any catalyst, you will get a slowdown, but maybe not a recession, basically. And that's what the Fed is saying. We don't want this expansion to end just because of us. We're happy to trim down the rates a little bit if needed, you know, basically, given the rhetoric on the trade tariff side, you know, basically. So we'll jump to the next slide.
Does that answer your question, Tom?
It does.
Okay. So this one, we have a lot of economic slides or indicators. This one is the most familiar for most of you folks here. You would hear the unemployment numbers. So right now, this chart gives you what were the unemployment rates at various times, looking from really 69 onwards. So it's a 50-year look back. What was the wage growth, the blue line, during those periods? These are nominal wage growth numbers, and what were the unemployment rates? So when you go into a recession, for example, 2007 on, unemployment started to perk up, and with the crash and you know, Great Recession, because of obviously the Merrills, the Lehman Brothers failing, obviously we had a credit freeze, and the economy just came to a standstill. Unemployment rate hit 10%. It's now at a generational low of 3 and 6. The wage growth is one other number people look at. How strong is the overall population benefiting from the economic activity? So from 2009, if you look at it, the wage growth, obviously, if there is slack in the economy, wage growth isn't there as much. But it started to pick up. Lately, when we passed the fiscal stimulus last year, we started to see a big pickup in wage growth. So right now, the wage growth is about 3% and change, nominal, adjusting for inflation, obviously. The bottom quartile of the workers haven't seen much benefits, but now they're starting to see. So wage growth generally has been weak during this expansion, has picked up a little bit. Overall, this tells you, again, unemployment is a coincident indicator, if I may go a little technical. It doesn't tell you what will happen tomorrow. It's driven by business confidence, it's driven by overall consumption. It tells you what's happening right now. So it's a coincident, not a leading indicator. And that's why we follow a lot of other indicators. So what else is strong right now outside of employment? Service sector, which is the bigger part of the economy, is pretty strong right now. Number two, consumption is pretty strong because people have jobs, they're spending, their taxes have gone down a little bit, they're spending more. Again, that is strong. Overall, the corporate profits are at high, margins are at secular high, albeit a little bit fractionally lower compared to last year. Because we're seeing revenue growth, but the pricing power for corporations is starting to weaken a little bit overall. So confidence is strong among small businesses. Housing is pretty strong with low rates, albeit peaking year over year. Service sector is strong. Employment is strong. What is weak? We'll touch on those areas now a little bit.
I have a question.
Yeah.
So wage growth, that includes the highest income earners and then the lowest.
Yeah,
So-
this is for non-supervisory workers. So obviously, if you're a salaried CEO, you're way ahead of this thing. But go ahead, yeah.
So is that number though, that doesn't include the highest earning?
Yeah, this is for mostly non-supervisory private sector jobs. Yeah.
For the blue collar workers, why that's important is because the blue collar workers are the ones that are really making things in the majority of our.
That's why I was wondering if that would skew that thing, if it included everybody.
No,
Yeah, it doesn't include the CEOs and the C-suite executives, obviously, and they're obviously we know the that share of profits has gone more to companies and higher earners, obviously. So that's.
I have a question. But what about the shortage of workers, labor? Is that going to be affecting that?
Which is what we are starting to see in low-end jobs right now. If you're working at a McDonald's and you have a better job paying you $12 or $13, you're going to leave the next day.
Yeah.
Likewise, office workers, there's plenty of jobs. But there's also a mismatch of skills. If you go and try to find a job in a professional field, sometimes you may have one skill but not the other one. There are 5 million plus listed open jobs based on Federal Reserve data. But a lot of them is skill mismatch. If you're sitting in Iowa with an associate degree, you're not going to be able to get a coding job with a company in Chicago possibly, and that's a skill mismatch. So you're stuck going to an office job in your area, obviously. But yeah, again, there's a little bit of skill mismatch. There's demand definitely for high-end professional jobs. There's also slack in certain areas, but to your point, yes, if there's shortage of labor, like we saw during the dot-com boom or during the housing boom, there was lack of construction workers. They were making 100,000 plus. Likewise, in dot-com boom, we have seen people show up for a job, and on Monday they'll resign and say, "Oh, I got another job paying me $10,000 more," especially in Silicon Valley. So yes, if that happens, that's the worry for Fed. That's when they start clamping down, basically, because wage inflation is something that doesn't help. I mean, it helps the workers, but if it's beyond certain limits, they start to worry about those. Any questions? Sorry, I hope we're not going too slow or fast. So this slide, it tells you what is manufacturing doing right now around the world. This is an index of global purchasing managers index, and that gives you an insight into the manufacturing activity around the world. Again, manufacturing is less and less of a impact on the global economies now because service sector, office job, professional jobs is becoming the bigger part of the economy now. So this is less of an impact, but it gives you an insight into the demand side of pictures of TVs and cars. We're starting to see Ford, for example. Ford came out with their quarterly earnings yesterday, and they talked about weak demand in China. Likewise, overall, even in growth countries like India and China, car sales are dropping like 5, 10, 20% here. Likewise here, we're seeing a lack of demand for cars a little bit. So that just gives you an insight into industrial goods, into TVs, electronics, whatever the produced goods are manufacturing. So right now, this gives you a time series heat map of the manufacturing activity from 2008 to right now. During the crisis, the red bars or the red areas indicate contraction in manufacturing. Green is good, obviously. Yellow is a caution area. So right now, we're starting to see a weakening manufacturing activity. If you look at a country like Germany, which is heavily dependent on exports to other EU countries and China and the world, it's in heavy contraction mode right now. And that's why European Union is already talking about cutting rates, even though they're at zero. Korea, which does produce and export cars and white goods, they're in contraction right now. Taiwan is another country, Taiwan and Korea. So we're in a flash yellow sign right now with the tariffs. We're at 50. So that's why Federal Reserve starts acting, So we're seeing a weakening trend here, and that's the concern, basically. Demand starts weaken, then employment weakens. So this gives you a forward-looking insight, and that's why, I say employment is a coincident indicator, not a leading indicator. One of the areas of concern right now is the trade and tariff issue at the forefront right now. So this chart on the top left side, it tells you what is the world trade volume. The economies were generally weakening, and this chart is a year-over-year percentage change, a 3-month smoothed out moving average, not a monthly data, but a 3-month average, and visualized as a line graph for you. So the trend is telling you that we're seeing the world trade volume going into contraction, and that's corroborated by what we hear from CSX, the railroad giant, or from FedEx. They're seeing weakening activity in their shippings around the world. So it's telling you a cautionary sign, and then you have the global tariff structure around the world. Emerging markets here on the left side tend to have a little more higher tariffs to protect their local industries as they become more industrialized, and then the developed countries usually have very low tariffs or no tariffs. So if you look at the charts here, the developed economies, UK, Germany, US, all of them have very low tariffs between 0 and 5%. US, these are the proposed tariffs. The light blue one, this is the imposed tariffs on China at 10%, and some of these were proposed on Mexico and Chinese goods, and they're not imposed yet. But if this gets imposed, you could expect the trade volume to weaken a little bit. It's impacting overall confidence level. If you hear from, we look at a monthly Duke CFO surveys, they're saying confidence is an issue, obviously, investment is an issue because of some of these concerns, obviously. And then you will see here on the right side, exports as percentage of their economy or GDP, which countries are more heavily reliant on exports. On the developed markets at the bottom, US is the least reliant on exports. So China has more to lose than US if they impose tariffs on us versus if we impose tariffs on them. On the developed side, Canada it relies quite a bit on us for their exports, but that's the most heavily export reliant economy. Here at the top, you see China is about 19% dependent on exports. Taiwan, South Africa, Korea, these countries are heavily reliant on exports because they produce a lot of these goods, the cars and white goods. In case of Taiwan, mostly electronics and semiconductors. And then South Africa produces a lot of minerals and industrial metals and gold. They export those things. So again, it gives you a snapshot of weakening trends on the manufacturing side. And we are hearing that anecdotally from railroad companies, from FedEx, from CFOs. So that's one of the areas. Next slide tells you what is the global growth activity. We get a lot of data on a daily basis. For example, GDP data came out today. You get jobs number, you get manufacturing data, service sector data. So around the world, a Citigroup has created an index of surprises, economic surprise index. Let's say you have a jobs number coming out today. It's supposed to be 100,000. If it came out at 120, that's a surprise. Next month, if it's supposed to be at 120 and came out at 140, it's a surprise. So you get a trend created by following those data points, and that's the index they've created for all these different countries. You see, generally the trend has been on the weaker side since March of 2018. The surprises have been more on the negative side. This is above positive, above the surprise on the positive side. Here the surprises are more on the negative side. So obviously it gives an insight into forward-looking data. Again, nothing guaranteed, but it could signal to us a little bit trouble ahead. The next slide is another such indicator. This is called ECRI Weekly Leading Index. They produce a composite economic data index, and they release every week. And this blue line is a 4-week moving average, year-over-year trends. The grayed out area, these are two recessionary areas. So when this index goes below a certain level, you're likely to see a weakening growth trend. And we're starting to see that since really early 2017. We have seen, and especially when the tariffs were announced, this activity started to weaken again. So overall, this is a composite index of various economic indicators. It gives you a trend where things are heading. We're in the 10th year. General slowdown is expected. But again, if you get a catalyst like a geopolitical event or earthquake or war that impacts a bigger state or a big country like Japan, tsunami in 2011, we could see a deeper slowdown or even recession again. So reason to be cautious. We're just sharing some of those anecdotes with you. I'll share one more with you here, and hopefully. This is a chemical activity barometer. Chemicals go into all kinds of manufactured goods, and this chart tells you what the chemical activity barometer is telling you and what the industrial production chart is telling you. So things are generally on the weakening side. I just wanted to share one more chart, and maybe not for the folks remotely, but any questions on the remote attendees, Andrea?
Not so far.
All right, good. So next chart, it tells you what the monetary policy is. What drives markets and economy, obviously. The economy has to be in general strength more, but fiscal policy, monetary policy, inflation, interest rates, all those things impact markets and confidence and investments, obviously. So these are, this is the 99-2000. This is the rates, federal funds rate that were in 2006 and 7. But this chart tells you what the Fed funds rate or the Federal Reserve lending rate was short term. It's at 240 or 238 as of June end. And the expectation is Fed is going to cut rates by a couple of times. So things change from year end. Now the market is pricing in a couple of rate cuts. Again, based on today's a little bit stronger than expected GDP data, they may hold off cutting rates beyond once or twice, so that creates uncertainty for the market. But bottom line is, when they start cutting rates, when the economy weakens, they start cutting pretty fast. This is half a point cut, 1% cut, and then again, here in 2006, they started cutting rates. They started to raise rates in 2004 onwards. 2006, they stopped raising rates, and then they started cutting pretty fast because the economy was weakening. So when they start cutting rates, they start to cut pretty fast. The takeaway here is basically in the prior cycles, we had a lot of firepower to cut rates. Right now, we're at practically neutral rates adjusting for inflation. So we don't have much room to cut really. They'll be done in 1 year if you get a weak economy. But as we saw here in 2006 and 7, cutting rates by 1 or 2% is not going to juice up the economy as much, basically. And this is on the positive side. I'm gonna share one more chart that will make your jaws drop a little bit. This is the Swiss yield curve chart. They have bonds maturing up to 50 years. And this is the chart created yesterday I pulled out. Everything is yielding below 0%. So if you were to invest in a 50-year Swiss bond, you will get negative returns when you get your money back, practically. That's right now, if you were to invest in a 2-year Swiss bond, the yield is minus 1%. The U.S. has never had negative rates, thankfully, but this is where Japan is. This is where Europe is. One, demographics. Two, as in aging population with less consumption. Number two, obviously they're not a big country, especially Japan. It's an island country, no immigration. And we have some dynamics favorable for us, generally positive immigration, but we have the baby boomers right now in the prime retirement age. They're in the 55 to 73 age range, baby boomers, so they're in the thick of retirement, you know. So we're gonna have the same problem. Europe is already in that mode, like Japan. China is coming up in 5 years. We're gonna have a population where, and that's where you hear this burdens on Social Security. There'll be less workers than beneficiaries in 10 years' time, possibly. So coming back a little bit, we'll jump a little bit faster here. This chart here tells you the spread between 10-year U.S. Treasury and 3-month U.S. Treasury bills. Bills and notes. What is the difference in interest rates? You might have heard the term yield curve or inverted yield curve in the current climate. When short-term rates are a little higher than long-term rates, that's called an inverted yield curve. In a normal environment, you have the shorter-term rates that are usually lower than longer-term rates, because longer-term investors or bond investors will seek a higher return for inflation, for credit quality and all. But in the shorter term, they know their money will come back in a couple of years from the government or from Apple or whatever, you know, basically. So when this is inverted, it usually portends economic weakness, and you see these grayed out bars. Every time the yield curve is inverted and stayed inverted for a little bit, we have followed it with a recession. Usually, this has predicted every recession over the last 6 or 7 recessions. Except for 98, every time this goes in inversion, it's proved to be a correct predictor. Again, no guarantees, just one market-based indicator, and that's why the Federal Reserve is cutting rates by, let's say 50 basis points or 25 over the next 6 months or so. The next chart, this is a chart created by Federal Reserve Bank of New York, one of their key branches or key federal bank areas, districts. This chart gives you the probability of recession using the treasury spread. The prior chart I shared with you, that gives you the spread between 10 years and 3-month treasury bills. Based on that chart, the probability of recession next year is at 32%. And the grayed out areas are what happens in that's recession area. So if you look at this chart and this spike, when the probability goes above 30%, every time you followed that up with a recession, you know, basically. Except for 1967-8, when we spiked up to 40% and came back. You know. It could happen here again, that probability will go down if Fed cuts rate by a couple of times and we get the resolution of the trade tariff issue. So again, no guarantees, but that's why we are positioned tactically defensive or cautious. The next slide, we'll jump to equity markets. This gives you the valuation metrics. If you're buying a business, a small business or a large company, publicly traded, you obviously want to pay lower prices, generally looking out 5, 10 years, or your time horizon being 2 years. So buying stocks, buying large cap or value or individual securities, you want to see what the valuation levels are, basically. So this top chart gives you the PE ratios, price to earnings multiple. What price you're paying for a stock when the earnings for that company are, let's say, $1. right now, you're paying about 20 times earnings for S&P 500 as an index, aggregate index. Versus if you look at Europe and emerging market, you're paying much lower prices for those indexes. If you look back here in 2010, the multiples were same for all those indexes. The divergence has happened more so over the last 3 to 5 years, and U.S. equities have been bid up more and more. And that's why, obviously international hasn't done well because of a reason, slow growth, less operating profit margins versus U.S. corporations. But overall, U.S. markets are a little bit pricier than overseas markets. If you don't know, or I should educate you, is emerging markets aggregate, the China's, BRICS, or Brazil, Russia, India, and a lot of European and Asian countries outside of these big four, they account for about 53% of the global GDP or economy. And they're, as a piece of the pie of the overall market valuation, they're only 14%. Again, a lot of U.S. companies sell good to emerging markets, obviously, and well-run companies. That's why it's a little bit on the expensive side, basically. The next slide. This is very easy to understand. A Buffett indicator that people can relate to. Warren Buffett, as you all know, is the legendary value investor. And he says ordinary investors, if they want to look up how pricier or cheap the market is, look at the aggregate value of all the outstanding stock in the economy, or S&P 500 company, or Wilshire 5000 companies, and see the overall value of the economy, basically, how cheap or expensive it is. And this indicator gives you an insight into that indicator. A higher value means the market is priced expensively. A lower value, as you see in 2009, when market was cheaper compared to the value of the economy. Value of the economy you think of in terms of the aggregate sales is around 21 trillion right now, and you get 8 to 10% margin out of that. So when this ratio goes down, stocks are cheaper. During the dot-com bubble, it was at 161. Right now, obviously, lower interest rates justify a little higher valuation for equities or financial assets, but it's at 140% right now. So you're buying stocks at much higher valuations if you buy them right now. If you just see a typical reversion to mean at 100 from 140, that'll bring about 28% correction in the market, which would bring us back to December lows practically. So again, it's not out of the ordinary for market to sell out just because things are expensive. The next slide tells you what happens to markets or equity prices during recessions, basically. U.S. recessions and the S&P decline. These 11 numbers at the top tells you what the bear markets were, the drops during those recessions. During the, this is post-World War II numbers only, but typically you see a drop on an average of about 30%. We'll focus on number 9, 10, 11. The 90s was the early 90s recession. That was the Kuwait War, Iraq War, Bush won. We dropped about 20%, and then we had the IT boom starting. So it pretty much didn't go down as much because valuations were much cheaper. And then the dot-com bubble was pretty pricey. And what was the reason for the backdrop that caused this fall of 49%? Because there was a commodity spike and the valuations were extreme at that time. The Great Recession of 2008 and 9, markets lost 57%, basically. And because oil prices went up to $150 in 2008, if you remember, gas in California was like $5 a gallon. And there was a Fed policy that was a little bit aggressive to prick the bubble, basically. The leverage in Lehman Brothers' balance sheet when it crashed or went bankrupt was 40 to 1 or 42 to 1. So imagine a 2% drop in housing prices, and they're holding those mortgage bonds. You're bankrupt, basically. And then you could have, drawdowns of 20-30%, even outside of the recession, basically, you know. You see the Cuban Missile Crisis, the 87 crash of Dow, 20%, the Black Friday or Black Monday, we dropped quite a bit. So on an average, and then what is not listed here is 15 to 20% drops we have seen in 2011, 2010, 2015, and last year 20%. You could have a drop of 15 to 20% just purely based on technicals or a negative headline like a tsunami or Iran war skirmish or something, you know, basically. Especially when valuations are extreme or expensive, you know. So the next slide. We also look at technicals, so we pay attention to fundamentals, which is what we're paid for, but technicals drive a lot of market movements. You know, this is a chart of S&P 500 index monthly, all the way from 2006 to last week, basically. And what you see is this is the main chart of monthly prices. And at the top and the bottom, what you have is called technical indicators, you might have heard. Relative strength index is something you want to watch for, and moving average conversion divergence, it tells you a story, basically. So what happened is 2007, we made highs in first quarter, and then we made highs in October. So this is the new high. On technical side, you want to see this bar to make new highs. It didn't make new highs. That's a technical divergence. So what happens is when you get a technical divergence on a monthly basis and the macro backdrop is weakening, you start to get a sell-off for no reason. Again, here we have seen 3 new highs in the last 18 months. January of 18, September, October of 2018, and this month. Technically, RSI is telling there's less and less demand from the investors, basically. So the demand is going up as stock prices are going up. Demand is going down as stock prices are going up. That's bad, obviously, and you get a correction immediately. You know, so again, both of these indicators on the technical side is indicating another issue, basically. You know, so overall, to wrap up, we're in the later stages of expansion. The monetary or interest rate backdrop is turning more positive from around the central banks. I think about 10 central banks have cut rates over the last 3 months or so, and Fed will cut next week, so that's positive. Inflation is benign. Manufacturing is weak and weakening around the world, especially the hubs like Korea, Germany, China are all experiencing it, and that means a weak demand picture. What else is positive? Again, employment is good, but we are positioned cautiously given some of the dynamics we shared with you. Late cycle, potential tariff escalation, and then Fed policy, obviously. Right now is becoming accommodative, but if things are strong, they better change their tune, obviously. You know. So again, technicals plus fundamentals suggest to be careful. We also have seen divergences, as I mentioned. Dow transports haven't made new highs. Dow made new highs this year. There's something called Dow theory. Transports and industrial stocks both have to make new highs at the same time. Dow made new highs in the industrial stocks, but the transports haven't made new highs, indicating there isn't enough demand out there.
It's a bad indicator.
Huh?
With the autonomous trucks, it's a bad indicator.
And you haven't seen the FANG stocks making new highs in really last 6 to 12 months. So tech has been the leader, but FANGs, or Facebook, Apple, Google, Amazon, and Netflix, none of them have made new highs in the last 6 months. So that's telling us that the demand is weakening and we need to be cautious. When we will go back, if we get a pullback of 10% or so overall, we'll, again, try to be conservative, but we'll dial back some of the equity allocation if the overall macro backdrop is still supported, basically. So with that, I'll stop, and if you have questions, otherwise I'll hand over to Andrew.
I have just a question. Real estate. I mean, this area, say Denver and some other places are really, really hot. And how does that relate to what this is? I mean, is this a shortage of real estate in certain
Generally,
areas?
I've lived in Champaign, Illinois. Generally, you're seeing that college towns, they're inviting more international students, Asian, Chinese, Indians, to come and study because they could obviously get more revenues or higher college fees from them. And that's helping boost local real estate in some of the areas like Ann Arbor or Champaign or Charlottesville, Virginia, basically. Denver, obviously, there's some demographic trends as we see all over, that this movement, I'm not sure there's movement to Denver, you might know, but there's movement to Sunbelt for sure. And that's why you see areas like Raleigh or Texas or Dallas booming. Companies, because of tax reasons, are moving to states that are more friendly. People love San Francisco, but they're moving out. For example, Charles Schwab is setting up a big hub in Dallas, Texas. This Bay Area is too expensive if you're not a tech person, So
Right.
that's some of the dynamics that maybe.
So with interest rates being low too, it's really helped keep the housing market up. And so as we continue to kind of, we saw the fact that we'll probably have another 2 basis points cuts this year. So in areas that are popular, and we're seeing those trends, where people are going to, again, areas that have favorable taxation. Texas is one that has one, and we're seeing a lot of headquarters move there. Denver, Colorado, in the Colorado area is one that has a lot of more liberal social policies, and so you see some movement towards those areas, away from, where California's been very popular because of the cost of living. Colorado is a new area that's up and coming, and so as long as interest rates stay low, you're going to see those trends continue. And obviously with discretionary income, that plays into it as well. So, one thing that we had in 2008, we had low interest rates, but people didn't have discretionary income. So people wanted to buy homes, but they couldn't afford them. So it kind of goes hand in hand with that. And as long as the market's going up and we have interest rates being low, you'll continue to see housing prices at least stabilize. I mean, we are starting to see them, especially like in Ann Arbor, we're starting to see them really kind of top out, but we're not seeing them pull back. They're still going for a full offer price. They're not necessarily going over offer like they were before, but they're going for full offer price. And we're seeing that in New York is another one. New York, has always been a hot market. We're seeing that pull back a bit. So we are seeing a topping, but not necessarily, pull back yet. Does that answer your question?
Yeah, I just read something like Vancouver and Toronto are just, they're like higher than San Francisco or New York. I mean,
Because you have those Chinese buyers, international investors. In Europe, you see Russians investing. Here, we have seen a lot of Chinese investors. That has stopped, but that's one of the reasons. Canada has a liberal immigration policy, and if you know that lady Hub Hay, CFO, the telco giant News, she has a multi-million-dollar property in Vancouver, basically. That's one of the group of subset of investors over there, bidding up practically, pricing out local buyers.
So it is, we used to see the influx to our country from the Chinese, but obviously we have not been as friendly to them. So we're seeing those dollars go more to Canada right now.
Generally, yeah. And sorry, to add, Illinois, for example, is seeing net outflow of population because of taxation issues. But where I lived with my job for a couple of years in Champaign, Urbana-Champaign, because of the college town, there was net inflow of population over the last 2-3 years compared to overall net Illinois seeing a net outflow of population. So that's an issue for Midwest states, but some of the areas like Ann Arbor are more isolated than others.
yeah.
So when the downturn happens, what do you do then? Do you have to go in like incrementally, kind of last indicators?
Yeah, so it has to be a stable backdrop of macro indicators. And if you have a stock-based account, there's always a sector in a downturn that turns sooner or later. So individual names we could be buying tomorrow or a week from now if we see a better value, basically. But we have turned tactically defensive since first quarter, and the market is up 8 to 10% from that time. It doesn't take that to lose in more than a couple of weeks, basically. For example, next week Fed comes out and says, "Oh, we're cutting rates by 0.25%. We're done for now. Don't expect much, and they sound a little hawkish because today's GDP number was stronger. Market technically, as I shared, is extremely overbought. That could bring it back to January lows, basically not December lows, but March, February levels. 5 to 10% correction happens anytime. If the backdrop is worsening, obviously, we are positioned defensively. There's no point in going aggressively defensive. If we see a possible opportunity to hedge something more by buying a volatility product, we may do so, but I think we're positioned more or less for the worst case scenario at this point. A little bit early, but again, the Federal Reserve also had to change its tune, indicating things are weakening, obviously, on the global level. So yeah, we'll be watchful. If we went into a defensive more, we don't want to obviously go aggressive. We'll be slow and watchful and gradual.
So what we try to do with our portfolio is even out the ups and downs. So, given the signals that we have now, obviously, we're pulling back on the equities portion. A lot of our picks have still outperformed the market as a whole. So even though the market has risen, doesn't mean that you've lost that growth. So we've been very cautious as far as picking positions that had the upside potential, giving you exposure to the stock market while at the same time protecting your principal on the downside. So that's always been our strategy in times of volatility. Now, if the market does continue to go up as it could, the Trump administration has been very clear that they're going to be aggressive in keeping the market up. So therefore, we will get buying opportunities in different sectors.
More so than that, they actually yelled in the fans, right?
Yeah, many times.
Does that
every
make
day.
you question their decision-making process and what they're communicating?
Well, Federal Reserve Chair Mr. Powell has said, everybody has a right to have their opinion. They're practically ignoring him on the front side. On the back side, they've ignored his tweets for the first 3 to 4 months. Only change the tune when the macro indicators start to suggest they're not gonna go negative just because he's saying something to do. They're not gonna say just because the president is saying we're not gonna do it. They will take action when their duty is called for it, which is stable inflation and full employment. If inflation is weakening, their job is to make sure, it doesn't turn into a depression like the 30s. So all the central banks have turned extremely dovish and tried to do the best possible to support economies, because everybody is facing those same headwinds of demographics and slow growth around the world. So they'll be helpful as possible, but ignore the rhetoric side of it.
I think the Fed's done an excellent job in really ignoring that. So where it's the first time in my lifetime where you've seen a Fed at odds at times with the administration. I think that they've done a good job as far as acting within their lane and moving forward.
There were rumors they were going to replace the Fed with this press guy.
Yeah.
Was that concerning? What was
Yeah.
that, Scott something?
I don't think the possibility of that happening. I mean, when you look at the Federal Reserve and what the Fed is actually composed of, which is member banks, right? And so, in order to replace him, I think that there would be repercussions that would be, very interesting. And I think that probably that was thought about. So perhaps that's why.
Well,
That guy killed Greg.
he had looked into it, but the language is Federal Reserve Chair last week or a couple of weeks ago, he was giving a testimony, semi-annual testimony to the House and Senate Finance Committees. They do every 6 months in February and July, and he was asked that question. Fed has said, or the president has said he's going to fire you. Are you going to, what are you going to do if he takes that action? He said, no, the law is pretty clear, and I'm going to serve my full term. So the law, it looks like, is you cannot fire without a cause or something.
So a lot of people that are in the administration that are some of them are friends of the administration, some are not. But when you're in a role like that, you're not supposed to be loyal to the administration. You're supposed to be loyal to the United States, right? And so doing their job means being loyal to the United States, regardless of who's in office. So that's what's.
Okay, so actually to kind of segue into that, because this upcoming election is going to be contentious, how do you feel that's going to impact, what's gonna happen in the future markets and everything, the economy? Because this election will be, I think, different than others we've had in the past.
Well, different, but yeah, not necessarily. I mean, I think
more contentious.
Well,
Trump has to run on a strong election.
Right,
So
exactly, I think
doesn't that mean they're
he's
gonna
basing
tweak
his
the leverage
reelection.
to make sure it goes at least another year?
Yeah,
on
I'll
the
answer the fundamental side.
On the economy more than other presidents.
Yeah, so, that was the
And immigration and everything, things you have been talking about, I think that because he's basing so much of his reelection on those issues, do you think there's gonna be more volatility?
Yeah, I mean, if
And
you.
low unemployment plus anti-immigration
Right.
equals
And
that.
messing with the
it's
feds and
generally,
everything,
yeah.
tweets,
Well,
all that.
generally, I'll comment on the fundamental side. If you think about 2016, if you think about 2000 election, when we had the dot-com crash, markets usually are very worried during the election cycle year. So 2000, 2008, we had the big crashes practically during the election year. That was the fear in 2016 when a two-term president leaves, and markets started to sell off a little bit in 2016. If you remember, I shared the chart. Bottom line is the macro trends started to weaken down, but then things stabilize, and so it'll depend on the macro data points. The existing president, incumbent, is hard to replace if employment is strong, if economy is good. So he has to run on a positive agenda. Obviously, these contentious issues will make it crazy. Federal Reserve, if they embark on a loosening cycle, markets will be okay. But yes, if it'll happen from June, July onwards, who the Democratic nominee is, what the policies are, and if there is a chance that Trump is going to lose, the big impact comes from the tax cuts that were implemented by the Trump administration. So if there is a fear of those tax cuts going away, market will start to sell off. That's purely from investment perspective. I mean, other dynamics, if you want to add something.
Yeah, simply put, the market likes certainty, right? And so, depending on what some of the polls will come out with, if he's in fear of losing, if some of the polls are saying that he's behind, we're going to see a lot more volatility. Regardless of what the administration is going to do to keep the market off. So, if we see that he's leading in the polls and continues to lead in the polls, again, the market is probably going to see a little bit more stability. Again, it's just based on the fact that market likes, market likes to be stable, right? Market likes certainty, so they know what to expect under the current administration.
You say they're going to spend, just in the presidential, they're going to spend $7 billion. So I don't know how you invest in that. That's not counting the local everything else. But
yeah, a lot of it will probably go to Facebooks and Googles, right? Ads. But no, I mean, markets, if you remember, the first couple of years of this administration, obviously was pretty volatile from the dynamics perspective. The Twitter everything was new. And market kept ignoring basically because the hope was policies will be positive for businesses. Confidence went up, and we may agree or disagree, but market obviously cares about the bottom line, So they'll ignore until we know the nominee, and until we know, hey, what is the probability of him losing or winning, So those last 3 to 6 months will be more volatile. Everything changes. If economy is weakening, then yes, we'll start to go crazy more, because market prices in a weaker profit outlook, a possible change of presidency, and that means they'll price it before the election ends.
Any other questions?
that was really great. Thank you.
I hope, we're doing it the first time, so obviously any feedback, positive or changes, we're welcome to take with you, so let us know.
Have some more breakfast.
As long as there's no test afterwards. Actually understood some of this, so you did a good job, because this is not hard.
Thank you.
At all.
So for those of you on the web, we are going to sign off at this point. Please do go to our website, www.dardenwealth.com. We will have blogs, like I said, and we'll also post this presentation. Thank you, and have a great day.
All right, thank you.